what would someone think, or what would you want to tell investors about typically what a Class A share is?
Yeah, so Class A is going to be more on the preferred distribution side. So just monthly payments. They want the distributions to come from the cash flow. So it's really coming down to how do I get my money back, or how do I make money?
Hey everyone, welcome to another episode of Real Estate Roundtable with MRTG Capital. I'm Tom Goodge, and as always, I'm with my friend and business partner, Mike Rohm. How's it going, brother?
Doing great. How you doing?
Awesome, doing great. Here we are again. Another episode, another week. We've had a busy week. We had a lot of deals we're reviewing, lots of things going on. It's like, for the viewers, we have property management stuff going on. We have deal review going on, on-site, remote. Every week's busy and it's fun.
Absolutely. Talking to agents, trying to, as we run those evaluations, we're getting more information, being out on site to walk those properties. There's a lot that goes in behind the scenes, and it's, interesting. There's no shortage of deals that are out there that we have to go after. We have to find.
Yeah, that's right.
Or they're on the market, wherever it may be. So, yeah.
You mentioned agents, and I think the unsung hero of real estate syndication or any real estate investor is the tenacity to follow up with agents who just refuse to get back to you on a deal.
Yeah, it's some listings that you see that are out there for a while. It might not be because of that building. It might be communication with the other side who's representing those sellers. So sometimes you think it's too good to be true, or like that deal should not be out there that long. It may simply just be the agents will not get back to you.
That's 100%. Well, and I want our next episode to be on the motel conversion that we did, just talk through like the process of motel, especially since we're going through so many, reviews of motels to convert right now. But that's how we got that other one too. Like she did not want to actually be there, to actually take calls, to do anything. Like, we want to give you our money. Can we give you money for this building?
We bypassed her and just wanted to go to the sellers. We said, can you just set us up with them? And she didn't even want to call them to set that appointment up. And I'm like, I think I ended up telling her, you represent them, their best interest, and we're trying to buy this place.
That's right.
We have to walk it, and we have to look at the units. She was not trying to do her job, and somehow she was, she told us that she was like top in the state, and it
was like, oh my goodness.
Yeah.
So yes, in a week, a lot of the behind the scenes, if we had a reality TV show, a lot of that goes on each and every day, for sure.
Oh, there's at some point in time, we're going to have a book, I always say, about instances like this and tenant stories. So
before we even kick this off, the amazing things that go on behind the scenes also from the different tenants and things of that nature. And that is the great thing to be an investor on the limited partner side of the house. You don't have to worry about a lot of that stuff. You leave that to us day in, day out. We're dealing with the tenants, the toilets. We're also dealing with the agents who don't return phone calls.
Right.
Those that are looking to sell their property that we, went to off market, right? That, say 2 days, and then 2 days turns into 2 months, turns into a year and a half.
Working on 2 years. Yeah. But consistency. That's what it is.
We are in the trenches for you to find the best deals possible, for sure, and doing anything and everything it takes to get it done. So, well, hey, today, the one thing we talked about that we wanted to share as it relates to, just kind of continue the theme in these early episodes of, hey, I'm a potential investor. I'm interested in real estate investing, but I don't know all of the ins and outs. Help me get some education, right? And I think one that, and it was something when we were looking into real estate syndication that was kind of interesting, were the different asset classes or the different classes of shares that you could have as an investor. Every investor is different in what they want, and that's why we meet ahead of time. right? When you fill out an investor form, or if we reach out and say, hey, would you be interested in real estate investing? We talk about what you're most interested in. What do you value now, right? What your value is today, and as it relates to your investments, may be different than it will be 5 years from now, 10 years from now. But today we want to just talk about different classes of shares that you could have in an investment. And it's very simple. We'll talk about, we're going to keep the lettering simple. We'll go A, B, and C. Every real estate syndication, especially whatever the company is, may do different letters. We're going to use A, B, and C today to make it easy, but you may have 1A, 1B, 1C. It's, who knows? They're all different, but it all means the same thing. So, well, to kick things off, the first thing, let's just once again keep it simple. For Class A, when I say Class A, because I'm going to say, you'll know right out of the gate, you're like, okay, I know what Class A would be referring to. What would someone think, or what would you want to tell investors about typically what a Class A share is?
Yeah, so Class A is going to be more on the preferred distribution side. So just monthly payments. They want the distributions to come from the cash flow. So it's really coming down to it's a safe way to receive your money back, because that's one of the biggest things everyone says. Well, in the syndication, how do I get my money back, or how do I make money? And this is one portion. So it's really just coming from the cash flow. Distributions, after expenses are paid, everything's paid. That's how they're receiving it. So it's, like I said, more on the safer side.
Yeah, that's right. I mean, hey, I have my 50,000, my 100,000, my $500,000 that I want to put into this deal. I don't care about long-term, anything. What I care about are my distributions. I care about those cash flow payments. I want my money to be working for me, and that is the way that I prefer it. And there are many high net worth individuals. That's exactly what they're looking for. Is like, hey, I like the upside, but you know what I care about right now is just that part of the deal. So if that is you, if you're like, I prefer cash flow, MRTG Capital, as an example, we pay quarterly, and that will be from the cash flow that is in the investment. So once again, just for those, following along at home, cash flow, when we say that, that's the money that is left over, or the net operating income after all of the bills, all the expenses are paid. The mortgage is paid by, the tenants. The cash flow is what's left over, and then that's what gets divvied up. And Class A is typically, like you said, a preferred return.
Yep.
So yeah, that's one that, once again, if that's of interest to you, then we definitely can talk about that and what that would look like in a deal. Now, from a Class B perspective, what changes a little bit, on that side of the house?
So that's really more of the appreciation. That's the long-term side of things. You're looking for the asset to really, grow. That's appreciate. Again, that's how we look at it. But that's why these motel conversions, you're buying them cheaper, you're putting the money into them, and you're having the revaluation at a much higher, much higher value later on. So they're really going for the long-term, bigger upside, is what they're looking for. So it's just a different type, it's more of a, I don't want to say a bet, but they're looking more for that, the bigger upside.
Yeah, I mean, you could say that too, right? Because I mean, nothing is guaranteed, right? And that's one of the things that we are legally required to disclose, right? You can't say, you are going to make $5 billion on this deal. Like, no, you can't do that, right? There's always risk in any investment, period, and real estate's no different. But at the end of the day, yeah, I mean, what someone says, listen, I see what you're doing in this property, right? I love the fact that there are jobs coming, Amazon's coming to this area, Google's setting up shop, insert whatever it is, right? Because those are things that we look at. We look at the market trends. We look to see, okay, what is this not going to look at like right now in 5 years, but what is it going to look like in 10? What's going to look like in 20? Right? It's everything's cyclical, but we're only going to be going into markets that we know are going to grow. Right. And then when a market grows, what happens? Right? The value of that property goes up, and that's what we care about that as well, right? And then, I mean, a lot of investors are like, hey, I am okay with my $100,000, coming out. The cash flow is nice. I don't care about the quarterly payments as much. I want that big upside in 5 years. I want that big upside when you guys do a cash out refinance. we have friends that call that mailbox money, right? I want the mailbox money
Mhm.
in 2.5 years when you do that cash out refinance, and then the bigger one when it goes to sell.
Yep.
Yeah, that's Class B.
Yep.
Now, when we talk about Class C, what would we mean by that?
So it's a mix of both. Some of the preferred distributions with the upside. So you're getting a mix of both. So you might receive the quarterly payments, not on the same rate, but at a certain rate, and then also with the certain percentage of the upside. So it's a mix. You see this in the short term, you're seeing money come back in, but you're also playing the long term game at the same time.
That's right. Yeah, no, plain simple. It's best of both worlds, right? Like, hey, I want cash flow, but I also want, the upside. I want to take part in both. What does it look like? And when we're spelling this out in the documentation, we'll be in any offering, it'll be listed what shares are available. And obviously those shares are going to reflect what we're wanting to be able to provide for our investors, reflect what the deal can handle as well. But yeah, you can have a mixture of both. You can have the best of both worlds as well. And that gets spelled out so that, hey, if you want to have a preferred return, and for us, obviously, when we say preferred return, I mean, our investors, any deal is going to have a preferred return for our investors.
Right.
Before anything comes to MRTG Capital, our investors are taken care of first, plain and simple.
Yep.
Right.
And these all depend on, the type of asset that we're purchasing. If it's an apartment complex that doesn't need a lot of, lipstick put on it, that's going to be more of a preferred return. There's not going to be a big appreciation possibly on that unit. Now, compared to a motel conversion, that is going to have, more Class B and C because it's going to have the cash flow, quarterly cash flow. But the upside is we're going through the conversion from a motel to multifamily. So really, it's going to be split up by the assets in the deals that we're doing. So not everyone will fall into category A or B or C in that sense. It depends. It's just if it's a long term cash flow play is why we're looking at an asset for purchase. It'll fall more in Class A scenario. So again, it just really.
I'm glad that you said that too, right? Because yeah, I mean, a motel conversion in and of itself, and once again, next episode we'll just talking about all the nuances of a motel conversion. But you want to take part in the cash out refinance. You want to take part in the sale because ultimately you are taking an asset that cost less, but it took a lot more capital up front to be able to get it rocking and rolling as well. And I mean, you find that in traditional multifamily apartment buildings as well, ones that have distress, whether it be owner distress or insert bad property management distress. And you are looking for that huge upside play there as well. But a stabilized property more often than not is, yes, it will appreciate over time and you want that, but it's more to your point, trying to get it at a good price for cash flow play, right?
Absolutely. Yeah. You buy it, you have the tenants pay off your mortgage over time, but you're making cash flow each month. So it's not going to shoot up in value for those reasons. You know what I mean? Like you're not repurposing anything. You're just keeping the asset for where it was, and it might have been a landlord who wants to retire. So there's just not a big end appreciation on those type of assets, So, and again, sometimes you just hit a home run with purchasing them a lot cheaper. So, and like you said, the motel conversions, other type of conversions, or apartment buildings that are empty because they need the renovations, there's going to be higher appreciation on those just because of the state that building is in. That's right at that time.
Absolutely. And I was just thinking, like, I mean, just to clarify too, any asset that we're looking at, and this is why we're not going to have 5,000 deals coming at you all the time. It takes us looking at hundreds and hundreds of deals. It's not just one that may cash flow a little bit, right? It's all of the variables that we're looking at. It's, hey, is it in a good area? Is it one that it will grow, right? Are we getting, are we finding an asset that has rents that are well below market rates? All of these factors have to play in part of it. And then on top of that, then we talk about, hey, does it, is this really one that is going to be an A and B play or a B and C play? Like there's so many variables, lots of work that goes into it. But I would just say this though, that's another reason why, you come to someone like us,
Mm-hmm.
because we are going to be there in the trenches for you, going through those hundreds of deals, if not, thousands of deals.
So we're working
Yeah.
there. Like we're getting there
To find that one, diamond for you as well,
Mhm.
that diamond in the rough there. So, wait, no, that's all we needed to cover today for sure. And I guess the other thing that we just want to say is, remember the biggest thing too, we've talked about this before, but make sure that you as an investor have a good team behind you. Make sure that you have, CPAs, and lawyers, that when you're reviewing documentation, when you're receiving it, that it is congruent and it matches for what you're looking to do.
Mhm.
Make sure that
Absolutely.
you have good, wise counsel that reviews things outside of just, you looking through things as well.
And then looking at the class A, B, and C, I mean, it all goes on your risk tolerance. Where I
Mhm.
was 10 years ago, 15 years ago is different than now. Back then it was all about the upside. I would say I was more looking for class B, like those are what I was,
Sure.
looking for. Now my risk tolerance, I like C. I would like the upside on with the stable quarterly payments. So it just, again, it really goes off of where you're at in your investing journey and where you want to go.
100%. So, well, awesome. Well, thank you so much. We're going to see you on the next one. And so stay tuned. Next one, we'll cover motel conversions and just every little facet that we've learned along the way, and what we'll be bringing to you as well.
All right. Thanks, everyone.
Cheers. If you would like to connect, please head on over to mrtgcapital.com and request time to meet with us to answer any questions you may have about real estate investing through a syndication. We partner with small groups of investors just like you, and we're always reviewing deals that could be of interest to you.